Let's get across the market open now. Josh Barker joining us from RiverX. Josh, good to see you on this Friday. Been another very big week earnings-wise. How would you describe what we've seen so far?
I think it's been pretty surprisingly good from a lot of ASX companies. There's been some pretty positive movements on the back of these reports so far, all except a couple of the banks, which are just weighing the market down after their incredible year. So I think generally it's been quite good from the update that's come through, but we are seeing the index off quite a fair bit this week, thanks to just a handful of companies anyway.
Yeah, well, how would you describe that movement we've seen in the banks off the back of those quarterly updates?
Yeah.
Which, I mean, clearly there's the consensus being that they're way overvalued at this point.
Yeah, but they're still up 20% for the year, and that's despite sort of 10 to 15% declines just this week alone. And it's really created a pretty big divergence between the US market performance, which is up about 2% this week so far, whereas the Aussie market is down over 2%, probably a little bit more today. So it's really dragged the index down, and this is in a week where we've had the RBA come out with their first rate cut, so it's probably not something we would have anticipated is the Aussie market to underperform by really what's 4%, just thanks to these earnings dragging it lower. But it is concerning. I think it's the first smoke signal for the future in terms of the economy on the back of consumer confidence. The rate cuts come, but it's come too late, and it's probably not going to come to any large effect to outweigh some of the systematic issues going on within the Australian economy. We're in a recession, let's be frank.
Well, certainly per capita recession over the past 7 quarters.
Exactly.
So would you expect then that earnings are going to come off further?
Yeah, I do think so, and we're sort of stuck in a rock and a hard place with net migration coming through, because that's putting a lot of pressure on the housing market. So there might be reforms about that. If they were to cut that off, obviously that would put a crater in the economy if things keep going the way that they're going. That being said, we do have an election coming up, so policies can change and shift quite dramatically if we have a change of government. But for the time being, I think that's these banks are showing some warning signs with the consumer. There's been citing of higher errors from NAB. I think it was ANZ and CBA spoke about a deterioration in the consumer profile, not something they're hugely concerned about, but definitely flagging it. And Bendigo obviously experienced a very negative reaction, 18% in a day, due to a NIM compression from people shopping around and really looking to refinance out of pure necessity. I think is the large majority of people anyway.
So what's your preference there at RiverX as to what you're going to do with the banks? Do you hold at these levels, or are you trimming?
No, I still think it's an opportunity to trim. Like I said, they're up 20% for the year. The yield, even at these levels, is probably sitting just under 6%. So it's okay, but it's not sort of at those historical levels where you're sort of happy to take on a lack of growth from the banks typically. So maybe when that gets up to an 8-9% and sort of maybe they're off another 10 or 20%, you're probably starting to consider it. However, there's areas of the market where we can focus on that aren't going to have that same volatility risk and just pay more of an income, to be quite fair.
Because the other big sector that's been weighing on the market has been in the resources with, and no surprise there given what's happened to some of those commodity prices. What's your view?
Yeah, not overly positive on some of the commodities in Australia as well. So if you think of the index being largely financials and materials, if you're not too favourable on those two big sectors, it's going to be tough for the index to go higher. And that's just on the back of sort of continued pressures from China. There's a risk of a trade war escalating between China and the US, particularly now that sort of tech has advanced with both sides. So I think that's going to be the catalyst that sparks a lot of the trade war, to be fair. Whereas we don't have any of the net benefit of that here in Australia. We are just, that traditional finance and traditional mining sectors. So I think it's going to be sort of a tough run for both of those, heavyweights of our market.
Now, elsewhere, credit assets, there are a number of new listings coming on. What's your take on what we're seeing there?
Yeah, I guess given the pressures in the economy and consumers specifically, so it's not something we'd sort of go into at these levels being discretionary. But that has been a sector that performed well over the last 3 reporting seasons. So more so leaning on probably like Australian property, I think is the focus. So whether that be sort of commercial or even residential, there's some plays there. But obviously with interest rates coming off, it does flow to their bottom line. And even just the stability that comes from credit assets lending to those asset-backed and property-backed assets within Australia, I think that's an area of the market that will continue to be strong throughout this period. So there's a couple out there. We definitely look for the quality managers. So Metrics have got a listed entity with MOT. Again, paying monthly distributions around that 9%. So you're getting a higher yield than on the banks and not taking on that downside risk. Capital growth is limited on these things. They're more of an income instrument, but I definitely feel that they have a place in portfolios, especially when you're quite negative on the market overall. So there's that. They're obviously a great manager. They're trading at a slight discount to NTA, which is always nice to buy at. Typically they've traded at a premium, and a lot of the Metrics assets have. And then there's a new listing from MA Financial, which gets exposure to their whole credit book. So by buying a piece of that, you're essentially getting exposure to 10 billion in credit assets. So you're not taking on too much loan-specific risk or anything like that. It's very diversified, and you're getting that monthly income come through. You've got that daily liquidity. You can sell it on market. So it really just creates a bit of a bedrock for the portfolio, and a turbocharged savings account while you're not wanting to take the risk in some of the sectors out there on the market at the moment.